The gentleman's recognized.
Mr. Speaker, today I rise in strong support of H.R. 3312, the Systemic Risk Designation Improvement Act of 2017. This very important piece of legislation was introduced by my friend, Mr. Luetkemeyer, who serves as chairman of the Financial Institutions and Consumer Credit Subcommittee of the Financial Services Committee, and it is co-sponsored by a bipartisan group of members of the House. In fact, Mr. Speaker, the bill was approved in October by the Financial Services Committee with a very, very strong bipartisan vote of 47 to 12. So strong, Mr. Speaker, that even a majority of Democrats on the committee voted to support the bill. This bill reforms what Republicans and now many Democrats acknowledge is a flawed and arbitrary framework under the Dodd-Frank Act to designate so-called systemically important financial institutions, also known as SIFIs. In fact, one of those Democrats who acknowledges that it is a flawed and arbitrary framework is none other than former chairman of the House Financial Services Committee, Barney Frank, the very Frank of Dodd-Frank, the co-author of the Dodd-Frank Act. He himself has said that this provision in the Dodd-Frank Act that many of us are trying to reform today is, quote, arbitrary, unquote, and, quote, a mistake, unquote. Those are his words, Mr. Speaker, not mine. That arbitrary and mistaken provision is Dodd-Frank's one-size-fits-all standard that subjects banks to $50 billion or more in assets to the same costly and cumbersome SIFI regulatory standards as trillion-dollar global systemically important institutions. We should take note that this flawed standard has now been criticized by Federal Reserve Chair Janet Yellen, former Federal Reserve Board Governor Dan Tarullo, former Comptroller of the Currency Thomas Curry, and many other Obama appointees. In other words, Mr. Speaker, it's that bad. Mr. Luetkemeyer's bipartisan bill, again very strong bipartisan bill, replaces this inflexible, flawed $50 billion threshold that has been criticized by so many with a series of well-established critical standards that more accurately measure systemic importance. Specifically, his legislation requires the Federal Reserve to review a financial institution's size, interconnectedness, global cross-jurisdictional activity, and complexity before determining whether the institution should be subject to heightened SIFI regulatory standards. In other words, this bipartisan bill tailors regulations based on a bank's actual level of risk instead of Dodd-Frank's one-size-fits-all system that ensnares smaller regional and mid-sized banks that essentially have simple community bank lending models. These banks are not globally complex Wall Street banks and shouldn't be treated the same. It simply doesn't make sense to subject small regional and mid-sized banks with only $50 billion in assets to the same expensive and cumbersome SIFI regulatory regime as a bank like J.P. Morgan Chase, which has $2.5 trillion in assets. Based on size alone, the $50 billion bank is just 2% of J.P. Morgan Chase's size. What does make sense, Mr. Speaker, is to base the regulation of these financial institutions on their actual risk profile rather than their asset size alone, which is exactly what Mr. Luetkemeyer's strongly bipartisan bill will do. Now, while I personally do not support the SIFI architecture at all and do not believe any financial institution in America should be designated too big to fail, it is important that we always continue to work to find bipartisan reforms where we can find them and improve current law, and the legislation before us today represents a good faith effort to do exactly that. And let's keep in mind, Mr. Speaker, this is simply not a debate over an arcane definition in law. It's about the real-world effect these regulations have on the U.S. economy and the working men and women that we represent. Let me share with my colleagues what the Small Business and Entrepreneurship Council has to say about the importance of the bill that we're debating today. Quote, access to working and growth capital remains a challenge for many entrepreneurs and small businesses. H.R. 3312 would improve the lending environment and unleash capital by alleviating inappropriate requirements imposed on regional and mid-sized banks under Dodd-Frank. Mid-sized and regional banks, which many startups and small businesses have counted on for lending, have been negatively affected by this Dodd-Frank arbitrary trigger. Mr. Speaker, the American people deserve better. They deserve a healthy economy with growing paychecks, better jobs, and a brighter future. It's time to restore economic growth fueled by capital flowing from America's banks to American communities across our nation. So I urge my colleagues to correct this widely acknowledged mistake in Dodd-Frank, even acknowledged by former Congressman Barney Frank himself, and put into place real, discernible, critical standards and help our struggling small businesses on Main Street. That's H.R. 3312, and I reserve the balance of my time.